In finance, we use the term risk quite a bit. In fact, we talk often about the risk-return trade-off, which is the trade-off between risk, which is bad, and return, which is good. Now, when we clump together these terms risk, there are actually a lot of different sources of risk, and that's what I want to talk about today. Risk, generally speaking, is the chance that the actual return from an investment is going to be different from what you expect. But what exactly is that? I mean, that's a sort of general term, but if you look at it, there are a lot of different sources of risk, so we can break it down. Some are applicable to some types of investments. Other types of risk are applicable to different types of investment. So one of the first types we can look at is exchange rate risk, or currency exchange risk. And that has to do with fluctuating exchange rates. So if you happen to be purchasing foreign securities or you're investing overseas, the exchange rate may change. And if you've ever seen a foreign mutual fund, sometimes the return will be quite good, but after you convert the money back to dollars, because the exchange rate changed, you actually did worse. On the plus side, sometimes your investments overseas didn't do very well, but when you convert your money back to US dollars from, let's say, Japanese yen, it turns out that you had a positive return simply because the exchange rates moved in a favorable direction. And some of the types of investments that are affected: international stocks and international bonds, ADRs, which are essentially foreign shares of stock that are held by a bank, and you can buy shares of those. When the dollar gets stronger against a foreign currency, that reduces the value of a foreign investment. Okay, a stronger dollar means it takes less US dollars to buy a unit of the foreign currency, or you can say it the other way, it takes more units of the foreign currency to buy one US dollar. So when you convert your investments from overseas back to US dollars, you actually get less dollars. Another source of risk is business risk, and that has to do with the risk the company faces that their earnings aren't going to be what's expected. Now, some types of businesses face greater earnings risk or greater business risk, others don't. Investor Warren Buffett, this is the kind of risk he looks at. Take a company like Coca-Cola, a company that he has for many years had invested in. Why does he like Coke? Coke doesn't have as much business risk as a lot of other businesses. Coke is fairly inexpensive. Even during a recession, people will still treat themselves to a Coca-Cola. There's not a lot of variability there. You know, if you lose your job, the one treat you have is having a can of Coke. People won't necessarily switch to Pathmark brand cola. So this is one of the sources of risk. Other types of businesses face a lot of business risk. Things go up, things go down, the economy changes. As I'm making this video, the computer industry is being hard hit. Why? Because people aren't buying notebook computers and desktop computers as much. They're buying tablets, they're buying iPads, they're buying other types of tablets. They're replacing their computer. So companies like Dell, in fact, as I'm making this tutorial, Dell is working on going from being a public company to being a private company. And the types of investments that get affected: common stocks, preferred stocks. Okay, companies can lose market share simply because management did a bad job, made poor decisions, but they may also lose market share because, like the computer industry, people are shifting to a different type of product. Firms also face something referred to as financial risk. And there are several ways to look at financial risk. From a firm's point of view, it has to do with the mix of debt and equity used to finance the firm. The more debt you use, the more money you've borrowed, the greater the financial risk. This is true for an individual as well. An individual who who borrows a lot of money to buy a large house, an expensive car, is at greater risk for bankruptcy than someone who's able to pay cash for their car and maybe even cash for their house, or at least takes out a small mortgage or buys a smaller house. Common stocks are affected by financial risk. Corporate bonds are affected by financial risk. There's also the financial risk that a company can't get an additional loan to grow. During the financial crisis of 2008, 2009, a lot of small businesses were not able to get loans in order to finance growth or finance their inventories. So this can be a problem for a lot of businesses as well. You'll see during tough economic times, sometimes companies will default on their bonds. They'll go into bankruptcy. Purchasing power risk. This is something that people don't always think about, especially on an individual level, but it has to do with changing price levels, inflation or deflation. We don't see deflation too often, but inflation where prices are going up. Oftentimes people will say, oh, I've set up my retirement plan, so I'm going to get, I'll have $100,000 a year until I'm 90 years old. And that's plenty of money to live off of. But if they haven't accounted for inflation, 20 years from now, that 100,000 may only be worth what 50,000 is worth today. So because prices have gone up. And you've seen that, okay? Even if you're quite young, you've seen prices of gas shoot up very rapidly over short time periods, and it has a big effect on your budget. So even though you're making the same amount of money, if the price of gasoline goes from $2.50 a gallon to $4 a gallon, that takes a big chunk out of your income, out of your living expenses. Items like bonds and certificates of deposit that pay fixed amounts tend to be affected a lot. You're getting a 5% return, and that's okay on your bond if the inflation rate is 2 or 3%. But if prices are going up 6 or 7% and you're only getting 5%, you'll actually be worse off, even though you'll have more dollars in your pocket. And they give a little example here of purchasing power risk. Last year you went to the movies, it cost you $8. This year it cost you $9. And you can think of bigger ticket items. When you bought a car 4 years ago, it cost you, $18,000, and now you're buying it several years later, it costs $20,000. Same car, same model. Interest rate risk is what happens to the value of the security when interest rates change. And bonds and preferred stocks, again, these fixed income investments, tend to be greatly affected by changes in interest rates. When interest rates go up, bond prices go down. Why is that? Because you're receiving a fixed payment on your bond. You might be receiving $80 a year on your bond. So it might be an 8% coupon bond with $1,000 face value. So you're getting $80 a year in interest. But if interest rates shoot up to 10%, new bonds are paying $100 a year in interest. So the bond that you have that only pays $80 isn't going to be as valuable. People will pay less for it, and the price will go down. So as interest rates go up, bond prices go down. Of course, as interest rates go down, bond prices go up. You also have to think about the reinvestment rate. If you happen to be getting money back, lower interest rates mean that you'll be reinvesting your money at a lower rate. So if you happen to be generating a return from your bonds and you're not spending it and you're reinvesting it and interest rates have gone down, you'll be reinvesting those at a lower rate. Liquidity risk deals with the risk that you won't be able to sell the item at a reasonable price. And there are a lot of things that are not very liquid. Real estate is one. If you want to get a fair price for your house, you may have to list your house for months and months, maybe even years. If you want to try and sell your house in a week, you're probably not going to get a very good price for it. Some small company stocks, ones that don't trade very much, can also have liquidity risk. It can sometimes be hard to find a buyer if you want to sell. It's not a problem if you're trading a large company stock like Microsoft or General Electric. But a small company stock, you may not be able to find a buyer, and if you do find one, you may have to sell it at quite a low price. Okay, same thing with your house. Okay, tax risk. We don't think about this a lot, but Congress can change laws, and they talk about it all the time. For example, they may limit or get rid of the mortgage interest deduction, which would make real estate less desirable. They may change the rules on IRAs and some of these retirement accounts. You may be familiar with a Roth IRA. A Roth IRA says that you put the money in after taxes, but when you withdraw it, if you follow the rules, you have to hold the IRA for 5 years or more, and you have to be 59 and a half to take it out. All the earnings are tax-free. Well, that sounds like a great deal, but Congress could change that rule anytime. Municipal bonds can be affected by this. Right now, those are free from federal tax. But again, Congress could change that rule, in which case your municipal bond will go down in value. Part of the reason it's valuable is you don't have to pay any interest on it, any tax on the interest you receive. Market risk deals with how the investment is affected by market factors, such as how the economy is doing as a whole, how fast is the economy growing, okay, how is inflation affecting the economy, okay, political upheaval, war, things like that. Okay, all investments are affected by market risk. Now, each type of investment will be affected differently by market risk, but all investments are affected by market risk. And finally, we have something referred to as event risk. That is, what happens when a specific event happens and affects an investment. Now, this affects all types of investments, and they give you an example here. A decrease in value of an insurance company after a major hurricane. Okay, decrease in value of real estate after a major earthquake. Okay, if you have real estate in an earthquake-prone area and there's an earthquake, a lot of times people will get rid of their homes. If there's a major hurricane, a lot of people won't rebuild those homes. So a lot of times your property value goes way down. You can get rid of the event risk by diversifying. That's why insurance companies don't insure all people in the same neighborhood. They insure people in different areas, in different parts of the state. Oftentimes they'll insure people in different states, in different parts of the country, because an earthquake doesn't hit the whole country, it hits a specific part. A hurricane hits a specific part of the country. So this is something you can diversify away. So some of these risks you can get rid of, you can diversify away. Others you're stuck with. But when we think about risk, we should think about all of these risks, not just risk as one big general heading. It's a lot easier to think about how to manage risk when you think about each type of risk.